Tulip Mania, 1637, often called the first financial bubble in history. In 17th century Netherlands, tulips weren't just flowers, they were a status symbol. Rare tulip bulbs became so valuable that people were trading houses and lands for a single bulb. It sounds wild, right? Things got so bad in 1637 that some tulips were being sold for more than 10 times the annual income of a skilled worker. But you know tulips are just flowers. They don't generate income, they don't grow in value, and they eventually go bad. Hence they don't qualify as a stock. People began realizing this and buyers stopped showing up at auctions and prices collapsed. People who had invested their life savings in tulips were left with worthless bulbs. The economy of the Netherlands took a significant hit. This is probably the only financial crisis in the list which didn't affect majority of the citizens. 2. The South Sea Bubble, 1720. The South Sea Company, a British company, promised to generate massive profits through trade with South America. Investors were thrilled and threw money at it without asking too many questions. Even King George I invested in the company. The stock price soared, and everyone from nobility to soldiers started investing, believing they'd get rich. Even Isaac Newton invested. But here's the twist. The company barely traded anything. It was all hype and no substance. By late 1720, people realized they had made a mistake and started selling their stocks. The bubble burst, stock prices crashed, and investors lost everything. Newton reportedly lost millions of dollars in today's money and famously said, "I can calculate the motions of heavenly bodies, but not the madness of men." The 1920 to 1921 recession. The 1920 to 1921 recession was a result of World War I. The war had left global economies stretched thin. Factories that had been producing war goods suddenly had no demand. Farmers were hit hard as agricultural prices collapsed. Unemployment in the US rose to 11%, and businesses shut down at alarming rates. What makes this recession unique is how it was handled. Instead of stepping in aggressively, the US government cut spending and let the economy correct itself. Surprisingly, it worked. The recession was painful but brief, and the economy rebounded within a year. The Great Depression, 1929 to 1939. 8 years after the previous financial crisis came the granddaddy of all financial crises. It started with the stock market crash on Black Tuesday, October 29, 1929. Back then, everyone was investing in stocks, often with borrowed money. When prices started falling, panic set in, people sold their stocks at a loss, and the market collapsed. More than 9,000 banks failed, millions lost their jobs, and families struggled to make ends meet. By 1932, the market had lost nearly 90% of its value, and everyone out of 4 citizens were unemployed. This led the government to establish Securities and Exchange Commission, SEC, to regulate the stock markets. Other countries around the world also faced economic hardship. It wasn't until World War II that economies fully recovered. 5. Black Monday Crash, 1987. October 19, 1987, Black Monday. The stock market dropped by a staggering 22% in a single day, highest ever drop till date. Imagine logging into your portfolio in the morning and finding out you've lost nearly a quarter of your investments by the evening. Many blame early computerized trading systems that created a domino effect of selling. Others say it was just a mix of fear and bad timing. Despite this, the market recovered relatively quickly. Within 2 years, stocks were back to their pre-crash levels. 6. The 1997 Asian financial crisis. In 1997, Thailand's economy faced a meltdown when its currency, the baht, collapsed. This triggered a domino effect across Asia, hitting countries like Indonesia, South Korea, and Malaysia. The crisis started because of massive borrowing. Governments and companies took on debt in foreign currencies. When the baht fell, it became impossible to repay those loans. Stock markets crashed, businesses failed, and millions lost their jobs. The IMF provided over $100 billion in loans to countries to help repay the investors' losses. The total loss is estimated to be north of $100 billion. 7. The dot-com bubble burst, 2000 to 2002. The late 1990s were all about dot-com companies. If a company had a website, investors were throwing money at it. Investors were funding these startups with billions in funding. Stock prices for internet companies soared, even though many of them weren't making any profits or even revenue. By 2000, investors saw the reality. Most of these companies couldn't deliver on their promises. The bubble burst and the Nasdaq lost nearly 80% of its value. Some companies like Amazon survived and thrived while most disappeared completely. Many investors lost trust in internet-based companies for a long time. The global financial crisis, 2007 to 2008. The global financial crisis started with the US housing market. Banks were giving out home loans to people who couldn't afford them. These loans were bundled into complex investments and sold as safe. When people started defaulting on their loans, the whole system collapsed. Lehman Brothers, one of the largest investment banks, went bankrupt because they were giving out bad loans to people. Stock markets crashed, and governments had to step in with massive bailouts from taxpayer funds. This crisis didn't just hurt investors, it cost millions of people their jobs and homes. The crisis spread globally, and countries around the world faced their own economic crisis. It took countries several years to recover from the losses and is termed one of the worst financial disasters in history.